Hey, I'm Beth Hochberger, CPA, CGMA, and today we're going to talk about how to maximize your rental income for your taxes. Hey, so really, um, I think one of the most basic things when it comes to maximizing your rental income and your taxes is being very organized with your records, because I have seen so many people miss out on so many deductions because they're just not keeping track of it. And yeah, you can be very organized. You can make spreadsheets, right? You can use software, whether it's QuickBooks or something specific for real estate, but you gotta do it because uh, I will tell you, I've had many clients over the years where they tell me their rental income and they might have a mortgage, so they give me the mortgage statement and maybe it's got the real estate taxes on it, and I'm like, don't you pay anything else for this property? And they're like, no. I'm like, you don't have insurance? You don't have maybe like lawyer fees, accountant fees, uh, pest, lawn, like all these things. And then they're like, oh yeah, oh yeah, oh yeah. So if I didn't prompt them and I didn't remind them, they would have missed out on all of those deductions. So that's going to be really your biggest thing. That is step one. If you're not capturing all of your deductions, right? Repairs and maintenance, every little dime, penny that you put into that rental property, then you're really missing out. And it's going to negatively impact you as far as your taxes. So, what are some of those expenses? Well, I listed a couple, but mortgage interest, right? And this is a big one. It's just the interest, guys. You don't get to take the whole payment. I know you're laying out more than just that interest to make the mortgage payment, but the only part that's deductible for your taxes on your rental property is the interest. No, people get mad at me. It's not my fault. I didn't make the rule, but that's the only piece of it that's deductible. Property taxes. Woo, I know here in Florida, those property taxes can be very high on a rental property. So make sure you're capturing all of that. Repairs and maintenance. If you're doing something simple like replacing a light switch, or you're doing a big project like replacing a roof, make sure you're keeping track of all of those things. Utilities, right? Water, electricity, whatever else you might be paying for running the property, that's your deduction. General operating expenses, whatever else that you're paying for, if you have a property management company, if you have cleaners, whatever it is you need to pay for operating and running that rental is a deduction. Now, some of you might even qualify for a home office deduction if you're using a area of your home to run your rental business. That one gets a little tricky sometimes, and not everybody's going to qualify. So if you have questions about that, drop a comment, because that one, it gets a little in the weeds, right? We're not looking to get too far into that in this. Now the big one, and this is where really rental properties, this is how it saves you money. This is how it helps you on taxes. This is that big tax break that people talk about with rentals. Depreciation, right? And again, it's not super simple. It's not that easy to just say, oh, well, this is what I paid for the property. That might not really be your cost basis, and you might be missing out. So it's really important to work with an accountant, CPA, somebody who knows how to calculate the adjusted basis of your property so that you get the full benefit of owning that rental for your taxes. It's super, super important. I will tell you that I've had many people do their own calculations, or they do their own cost segregations, and I have to go back to them and be like, hey, you got to redo all this because it's wrong, right? You didn't know how to calculate it. You didn't know what you were doing. You thought you were just going to DIY, and it's wrong, and you got to go back and do it again. So do it right the first time, right? Why go through all that hassle of doing it, being told you did it wrong, and having to do it again? Do it right the first time. Save yourself a lot of money and heartache. Now, when you're dealing with real estate and you're dealing with rental properties, there are different ways that the properties can be, I'm going to call it bucketed, right? They can fall into different buckets. Not every real estate activity that every person does is going to be able, if it's generating losses, it's not necessarily going to be able to offset other income, right? So if you're like, hey, I bought a long-term rental, I saw an infomercial somewhere and it said get rich with real estate, so I bought this long-term rental and I have a loss. Why isn't it showing up on my tax return? Well, that's probably because it's a passive activity. And a lot of the real estate that you're going to invest in, for most normal people that have W-2s and it's not the main thing that they're doing, it's often going to be passive, which means likely you're not going to see a lot of tax benefit from it. It's the reality. People don't like that answer, but it's the truth, and I'd rather you know the truth, is that for a lot of folks, if you're doing a long-term rental, it's probably passive, meaning if you're generating a big loss like in the first year or two, you're probably not offsetting other income unless your overall income is low, right? There's very specific scenarios where it might offset some of your other income and some of it is allowable. But for most of the clients that we deal with, their income is too high for passive real estate losses to give them any benefit. But that doesn't mean you shouldn't invest in real estate, right? There's other ways that there's benefit for you. For example, you are hopefully cash flowing for almost nothing, right? You bought a property, you're hopefully covering your costs each month, and you're paying zero tax on that, as the value of the property itself is inherently increasing because over time property values rise in general, right? Now, short-term rental, whole different world, right? Short-term rentals have the ability to offset your regular income. And we use this as a tax strategy with a lot of our clients. If you're a high earner on a W-2, right? This is one of my favorite tax strategies, is to get you into a short-term rental, because A, you get the benefit of you buying an income producing asset, and B, we can offset your W-2 wages with losses from that rental property. But again, you have to do it the right way. You can't just buy it and say, well, now I've got a property manager and, I don't really think about it. I'm not really involved. I don't do anything. No, it's not going to work. You're going to get stuck back in that passive category, right? So there's some qualifications, right? And maybe we'll go into that in a different video. But the short-term rental specifically, and short-term meaning 7 days or less, right? Florida, we have a lot of communities here where they're like, oh, your rental property minimum 30 days, right? So it's not going to work for you. It's too long of a rental period. But if you can get the short-term rental average down, way down to an average of 7 days or less, then we can work with that. We can help you figure out how to use those real estate losses on your short-term rental to offset other income. And that's really, really exciting. Now, if you're a real estate professional, everything I'm talking about doesn't apply to you for the most part. Real estate professionals are in their own group. They have their own rules, right? So a lot of times what we like to do is we love to work with people who just happen to be real estate professionals, but a lot of times we might work with a couple where one maybe is a high earner on a W-2 and the other one is not working a formal job. They're not in a W-2 job. And we get them qualified as a real estate professional so that we can use a lot of these real estate tactics without having to limit it to just short-term rentals. So there's some really cool tax planning things that we can do for couples and for individuals, right? There's a lot of stuff. It just changes. Your specific scenario is going to dictate how this is going to work. But again, it's they call it personal finance because it's personal, right? So if you're into real estate, if you've got those long-term rentals and you're generating passive losses, the best thing I can tell you, my best advice is figure out something that can generate some passive income, and they'll net each other out and they'll zero out. Otherwise, when you sell the property, in the year that you sell a passive investment, any built up losses become non-passive that year and can offset. But real estate, you're generally not selling it every year, so it's going to take a while. But we've got ways of sucking up those those passive losses if that's in the situation you find yourself in. But just to summarize, because I've been talking for a long time here, real estate, rental properties, fantastic way to either kind of, I'm going to say shelter. It's not a real shelter. It's not a real tax shelter. So I'm air quoting, shelter your income by making sure you capture all of your expenses. Make sure you're maximizing your depreciation. Use a professional to help you calculate that. Don't try to DIY it. It's not that easy. And if you're long-term rental property, you're probably a passive activity. If you need that to offset W-2s and other kinds of income, you're looking at short-term rentals, but you got to do it the right way, right? Not all real estate's created equal. Not everyone's participation in real estate is the same, and not all tax treatment's the same. So if you have any questions after that, and I hope you do, because that was a lot of information coming at you really fast, and it's confusing. It really is. It's not the simplest area. Please, please, please get in touch with us. Hop on the calendar, schedule with our office. Happy to talk to you about your specific situation and how you can maximize and optimize your rental property taxes. And we'll see you next time, guys. Thanks.